common trading strategy makes use of a hedge to protect a single share position with a CFD. CFDs are especially useful as a hedging tool because a short position can be replicated to hedge the exact position size required. For example, you may have a long-term share portfolio that you know you want to keep hold of, but you're worried that it may lose value in the short term because the markets are heading down. You can take out a CFD that could profit from a drop in the share price and help offset the loss on the physical holding. Here's 3 situations when it's a good idea to hedge. One is when the wider market or a particular stock you are invested in is moving against you. Another is when a market position has already moved sharply in the direction of your trade and additional gains may be marginal. And another is when the wider market looks weak and doesn't react to positive or negative news. There are also some times you should avoid CFD hedges. One is when a trade has moved sharply against you. The market is prone to reversing, and where hedging near these levels, all you would be doing would be locking yourself into a large loss. You should also avoid hedging in raging, bullish markets where everything seems to be going up. Let's take an example. Imagine you hold 10,000 Marks & Spencer shares and you think that their price had its run, but you don't wish to sell your physical stock. Maybe you're worried about the capital gains tax or even the dividend yield. It is September 2010, and with a looming VAT increase, you reckon that this may translate in some short-term price weakness in Marks & Spencer's stock. However, you still believe that Marks & Spencer are probably a good long-term investment. Originally, you bought the 10,000 Marks & Spencer shares at 227 pence in July 2008 for a total of £22,700. At the moment, Marks & Spencer is trading at 346 pence, but you expect short-term price weakness due to the VAT increase, making merchandise dearer to buy. So you decide to hedge your position rather than sell the shares outright. So you sell an equivalent number of CFDs at the current market price to offset your share investment and create the hedge. That will be 10,000 Marks & Spencer's short CFDs at 346 pence to cover the 10,000 of Marks & Spencer shares you own. Given that CFDs are traded on leverage, you only have to pay 10% of the total value of Marks & Spencer's shares at a cost of £3,460. That is the 10,000 shares multiplied by the 346p price multiplied by 10%. At this point, one of the following 3 scenarios can take place. What if the stock prices rise? If the stock price of Marks & Spencer were to rise further, you gain on your stock trade, but this is offset against the loss on your CFD trade. So for instance, if the stock price rallied from 346 pence to 390 pence, you would make £4,400 on your share trade, but lose £4,400 on your CFD trade. If you believed that the stock price is going to keep rising, you would always close the hedge by buying back the CFDs you sold. What if the stock price falls? If the stock price of Marks & Spencer were to fall, you gain on your CFD trade, but this is offset against the loss on your stock trade. So, for instance, if the stock price fell from 346 pence to 300 pence, you would make £4,600 on your CFD trade, but lose £4,600 on your share trade. If you believe that Marks & Spencer's will stop falling, you could close the hedge by buying back the CFDs you sold. Finally, what if the share price stalls? If the stock price doesn't move, you will neither gain nor lose on either your shares or CFD trade. Irrespective of the stock price movements, the hedge allows you to retain any profits from the point at which you employ it. Hedging via a CFD allows you to protect physical share positions without the complications of traditional short selling like borrowing shares to sell.